Yep, sorry, the title was clickbait, and this isn't one of those hype tuber crash videos. But the point remains, and if you watch the whole video, you'll see what I mean. Every YouTuber and his dog are doing the "oh no, a crash" type videos right now, so I wanted to join in, and here's my take. But first, hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that will be discussed is intended for information and educational purposes only, and should not be considered investment advice or investment recommendations. Whenever you invest, your capital is at risk. Let's imagine there's two people who both turned 18 and were given a sum of money in 1985. One of them, let's call him Chilled Out Charles, just decides, heck, screw it. I'm just going to invest in the top 500 companies and see how it's doing in 40 years when I'm close to retiring. I have faith that everything will work out. The other, let's call her Anxious Andrea, decides that she'll do her research and choose the perfect time to invest so she can really make the most of her money. She doesn't mind hanging on to her money because she thinks she can optimize the investment. Charles puts his money into a broad market index ETF and then, I don't know, becomes a monk or something for a few years. We'll come back to him later. Andrea, on the other hand, starts doing some studying and paying attention to the news and Jim Cramer and TikTok influencers, or whoever the equivalent of Jim Cramer and TikTok influencers were back in 1985. And let's see how she gets on. 1985, economic growth slows. Real GNP growth slows to 2.2%, inflation is rising, and this is what economists might call a bad combination. Monty Gordon of Dreyfus Corp said that 1985 is going to be a fairly difficult year for stocks. He sees the economy growing more vigorously early on, although familiar problems of the trade deficit, federal budget deficit, and upward pressure on interest rates will remain. Andrea thinks, low growth and inflation, disaster, better wait to start investing until the environment looks a little better. She decides to put off investing for a year to see if there's a better opportunity coming up. 1986, the Dow hits 2000. The market's booming and it doesn't really make sense to be so high, everything feels like it's overvalued and the bubble seems ready to pop. Andrea thinks, the market's way too high, I can't believe people are buying stocks at this PE ratio. The valuations are insane right now. So she waits another year. 1987, the crash, Black Monday. Markets crash worldwide. Black Monday is known as the day Wall Street crashed with the largest one-day stock decline in history. On the October 19th, 1987, the Dow dropped 22.6% in one day, causing a market chain reaction. Andrea thinks, good job I didn't invest, let's wait until it stabilizes. She waits another year. 1988, fear of recession. Some confidence after the crash has returned, but anxiety over growing inflation and interest rates remain. Andrea thinks, recession risk? Better hold off until that passes. She waits another year. 1989, junk bond collapse. Junk bonds crash, Drexel Burnham is bankrupt. According to Dan Stone, a former Drexel executive, the firm's aggressive culture led many Drexel employees to stray into unethical and sometimes illegal conduct. Andrea thinks, this won't just affect junk bonds, the contagion will spread, just you watch. I'd better wait. So she waits another year. 1990, the Gulf War. Oil prices surge, the worst market decline in 16 years. Andrea thinks, a war? No way I'm investing now. She waits another year. 1991, recession and market highs. Economic problems worsen, but the stock market rallies. Andrea thinks, the economy's weak, this market must crash. So she waits another year. 1992, elections and flat market. Andrea thinks, let's see who wins and what they'll do first before I start investing. She waits another year. 1993, business restructuring. Analysts say that in the long run, corporate restructuring should make firms more competitive and their growth may lead to a resumption of their employment growth. But until that stage is reached, employment growth could continue to be sluggish and recovery vulnerable to setbacks. Andrea thinks it's better to wait until the restructuring is over. She waits another year. 1994, interest rates rise. In 1994, the Federal Reserve raised the federal funds rate by 250 basis points from 3% to 5.5% throughout the year. Andrea thinks, why take risks on stocks if savings accounts are decent? She waits another year. 1995, the market is too high. Stock prices soared in 1995, arguably the best year in history. Andrea thinks market's up again, must be a crash coming. So she waits another year. 1996, fear of inflation. Andrea thinks, worldwide recession? Yikes. She waits another year. 1997, irrational exuberance. Alan Greenspan warns of asset bubbles. Andrea thinks, if the Fed chair is worried, so am I. So she waits another year. 1998, Asia crisis. Currency collapse across Asia. And Andrea thinks this could probably spread. Better to stay out of the markets right now. So she waits another year. 1999, the year 2K bug. Andrea thinks computers might crash and better wait for year 2000 and see how it pans out. So she waits another year. Year 2000, the tech bubble bursts. Nasdaq tanks 39.28%. Andrea thinks, phew, glad I waited. She waits another year. 2001, 9/11 and recession. Andrea thinks, too much uncertainty, so she waits another year. 2002, corporate scandals such as Enron and WorldCom. Andrea thinks, I can't trust these companies at all. She waits another year. 2003, war in Iraq. Andrea thinks, another war, markets will suffer. She waits another year. 2004, US deficits. Andrea thinks, budget mess? No thanks. She waits another year. 2005, record oil prices. Andrea thinks, high oil equals bad for business. So she waits another year. 2006 to 2009, housing crash to global recession. Andrea thinks, thank goodness I wasn't in the market. She waits a few more years. 2010, sovereign debt crisis. The European sovereign debt crisis raises fears about the financial stability of entire nations. Bailouts, austerity, and talks of countries leaving the euro dominate headlines. Andrea thinks, countries are going bankrupt now? That can't be good for global markets. I'll wait for things to stabilise. She waits another year. 2011, the Eurozone crisis. Contagion fears rise as Greece, Portugal, and Ireland struggle with debt. Stock markets become volatile and there's serious talk about a Eurozone collapse. Andrea thinks this could spiral out of control. Better not risk my money until Europe gets its act together. She waits another year. 2012, US fiscal cliff. Automatic spending cuts and tax increases are about to kick in unless Congress acts. Media coverage warns of an economic disaster. Andrea thinks, if the government can't even pass a budget without threatening the economy, how can I trust this market? She waits another year. 2013, Fed tapering. The Federal Reserve announces plans to reduce its bond buying program. Fears of rising interest rates trigger volatility, especially in emerging markets. Andrea thinks, markets are addicted to stimulus and now it's being taken away. This won't end well. She waits another year. 2014, oil prices plunge. Oil prices fall dramatically due to a supply glut and weakening demand. Energy stocks tank and economists warn that this may indicate a global slowdown. Andrea thinks if oil demand is falling then the global economy must be slowing down too. Doesn't feel like a good time. She waits another year. 2015, Chinese market crash. China's stock market crashes twice in 1 week, wiping out trillions. Concerns about the world's second largest economy shake global markets. Andrea thinks, if China sneezes, the world catches a cold. I'll better wait for this to blow over. She waits another year. 2016, Brexit and US elections. The UK shocks the world by voting to leave the EU. Later in the year, the US election causes massive political and economic uncertainty. Andrea thinks this world is getting too unpredictable. With all this political chaos, now is not the time. She waits another year. 2017, Bitcoin mania and record highs. Stock markets hit new all-time highs. Meanwhile, Bitcoin skyrockets, creating overnight millionaires and talk of a new financial revolution. Andrea thinks everything's going up way too fast, feels like a bubble to me. Better not jump in now. She waits another year. 2018, trade wars and rising interest rates. The US and China engage in a tit-for-tat tariff war. The Fed continues to raise interest rates, causing market jitters. Andrea thinks trade wars are never good for business and rising rates mean more volatility, not worth the risk. She waits another year. 2019, slowing India GDP. India, once seen as the next big growth engine, reports its slowest GDP growth in years. Global slowdown fears rise. Andrea thinks, if even the fastest growing economies are slowing down, what chance do the markets have? She waits another year. 2020, COVID-19 crash. A global pandemic shuts down economies around the world. Stock markets crash in record time before partially recovering. Andrea thinks, this is the apocalypse. The market is going to collapse and stay down for years. No way I'm buying now. She waits another year. 2021, Delta and Omicron. Just as things seem to be improving, new COVID-19 variants emerge. Concerns over vaccine effectiveness and lockdowns return. Andrea thinks, until we're really done with this pandemic, I'm not putting a cent into the market. She waits another year. 2022, Russia-Ukraine war and inflation surge. Global instability rises as Russia invades Ukraine. Energy prices spike, supply chains are further disrupted, and inflation hits levels not seen in decades. Andrea thinks this war could escalate and inflation is eating away at everything. Central banks are panicking, better wait until things calm down. She waits another year. 2023, banking instability and recession fears. Silicon Valley Bank collapses, triggering fears of another financial crisis. The Fed keeps hiking interest rates to fight inflation, and everyone's talking about a hard landing. Andrea thinks, banks collapsing again? This is giving 2008 vibes. And if a recession is coming, stock prices will drop even more. Better not touch anything yet. She waits another year. 2024, US elections and geopolitical tensions. It's an election year and the political climate is more divided than ever. On top of that, tensions between China and Taiwan are rising, and the Middle East sees renewed conflict. Andrea thinks, elections always shake things up, and what if China does something drastic? I don't want to be caught in the crossfire, literally or financially. She waits another year. 2025, Trump tariffs. Andrea thinks every year, still not a good time to invest. Meanwhile, chilled out Charles, he just left his investment alone. If chilled out Charles invested $10,000 in a broad index ETF like the S&P 500 in 1985 and just left it alone until 2025, his investment would have grown to approximately $542,614.16, all by doing absolutely nothing but staying invested. Pretty chill. Was Charles a genius? Maybe. Was he just lucky? Probably. But most of all, he had faith in the market and stuck to a very simple plan. He had a strategy and didn't get distracted from every bit of news that came his way. The lesson? If you want to save yourself from stress, consider your strategy and stick to it. Don't get swayed by the news or even worse sources. Now, I also need to address this concept of sell now and buy in cheaper later, as this is inevitably thrown around every time we see a crash. Now, you might be thinking, okay, fine, maybe Andrea waited a bit too long, but what if you just get in, then jump out before the crash? Sell high, buy low, get rich on the dips. It sounds like a good strategy, but let's break down the reality of it. Let's say you're trying to time the market. You think you're smarter than the average investor. You've got BBC News or insert news channel of your preference on in the background, your finger on the sell button, and you're watching every economic indicator like a hawk. But here's the problem. Nobody can consistently predict when a crash will come, how long it will last, or when the recovery will start. And missing just a few of the best days in the market, that's where it really hurts. Let's take two investors. Steady Sarah just buys and holds. She doesn't even flinch when the news screams recession. Timing Tom tries to be slick. He sells whenever he thinks a crash is coming and buys back in when it feels safe. Over 20 years, the market might go up, down, sideways, loop-to-loop, but guess what? Sarah's portfolio usually ends up growing way more than Tom's. Why? Because while Tom was sitting in cash waiting for the perfect moment to re-enter the market had already recovered. He missed those big up days, and they almost always come right after a crash when no one feels like investing. Imagine bailing out of your investments during March 2020 when COVID hit. At first it seems smart, you aren't facing the massive downturn in your portfolio like everyone else. But it's a pandemic, but the economy is shutting down, but toilet paper is out of stock. If you sold then and waited for good news, you missed out on one of the fastest recoveries in stock market history. And that's the market's cruel trick. The best days come during the worst times. If you do this kind of thing, you have to be right twice, both on the way out, selling before the market's trends worse, and, most importantly, on the way back. If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!